Ladies and gentlemen, welcome to the September webinar series from Woodburn Accountants and Advisors. The September webinar series is a webinar per day this week, so all the way Monday through Friday, about the theme of getting ahead of your China numbers. So today we're going to be looking at how to get your profit out of China. Tomorrow we will be looking at whether you have the financial resources to survive in China. On Wednesday, we're going to look at tax planning and the tax benefits that exist for foreign investors. On Thursday, we're going to look at VAT. What is VAT? What is the golden tax system? And then on Friday, an important question, as nobody can enter China at the moment: how can you operate your bank account from sitting abroad? So today is the day we talk about profits, which is probably the #1 question I get asked, which is, Christina, if I establish an entity in China, how can I get my money out? Is there a way to get my money out? Will the government stop me from getting my money out? What do I have to consider when I'm doing any form of overseas repatriation? So hopefully I'm going to answer those questions today. And again, if you've got any questions throughout today's presentation, please insert them in the chat box. The Q&A is generally the most exciting part of the day because we start interacting and using case studies as actual examples. So don't be shy, please use the chat box and ask away. Before we start, there are a lot of new names for me, so it would be great to understand where people are at in their China journey. So if you are a newbie, just type in newbie in the chat box. If you are a startup, type in startup, or if you're an experienced China hand, let me know. Basically, this is a way for me to understand who's in the audience today live, and it gives me an understanding on how to present the information, whether I can fly through or whether actually I need to slow down and explain a couple of things in more detail. Okay, well, the first two were experienced. The first three are experienced. A couple of newbies. All right. So a couple of you that have no experience in actually doing profit repatriation. Seems to be more experienced than not. Okay, for those of you that are not at all, that are newish, newbies, startups, this will probably pertain to you more as you are setting up your businesses, because the most important aspect is developing profit repatriation strategies as soon as possible. Okay, so I'll gear the presentation more in that avenue. If you are experienced, but you've actually never done profit repatriation strategies, you've never implemented them, you don't know what kind there are, it's never too late. There's always a good starting point to develop those strategies now. You just might have to think about them in a slightly different way. So how the webinar works is basically I'm here to teach you. So I'm here to educate you on practicalities. We can all read the legal documents associated with the newest regulations that come out. My philosophy is, what do those regulations mean in practicality when you're actually physically operating in the Chinese market? So we're going to be looking at a variety of things today, everything from the types of profit repatriation that can be developed, as well as the document list that should be submitted as a minimum, as well as the actual transactional process with the bank. Okay, so real practicality things that you need to take when you're on the market and you physically have to do these types of transactions. So as I go through this, if you have any questions, please ask. Remember, I'm talking about profit repatriation, everything from dividends to the strategies you can develop. I will touch on briefly on the personal side of things if you want to repatriate your own personal income out of China, how that works. But again, if you have any questions, type them in and we'll hit the Q&A. We are using Zoom meetings today. So I have muted everybody. Once we hit the Q&A, if it starts getting a bit complicated reading of all the text, I will unmute you in order for you to ask away. But in the meantime, as we present, I've muted everybody. And it's up to you whether you want to keep your videos on or not. We are recording today's session. So please make sure that you either keep your video on or you don't. And for the recordings, it will be posted up on our YouTube channel at the end of today, and a link will be provided to everybody. I will not be distributing my presentation. I've had bad experiences in this in the past, so there will be no PPT sent out. You can look at the recording, and if you've got any questions, you can ask me in a one-to-one meeting. If you run into technical difficulties, my only recommendation is log off, log back in. If it still doesn't work, just know we are recording this, and you can look at the recording later on. If I run into any technical difficulties, which hopefully I won't because kids are not home, husband's not home, it's only my laptop on the Wi-Fi, so it should be working. Then if it does happen, usually I need about a minute to reboot the whole system, reboot the Wi-Fi, and get back on. I will be coming on to finish the presentation. If you are able to stay on, please do. If due to time restrictions, I understand, log off, and I will send you the recording later on. Again, the best part of these webinars is the Q&A, so please don't be shy to ask away. And just as a reminder, because most people usually always register for the first webinar before they register for the others, if you are interested, we've got 4 other webinars this week, all about looking at the financial resources. So how do you bring the money into China? Looking at the preferential tax policies and tax planning. How does VAT work? What's the golden tax system? What are FAPIAOs? And then do you have the capabilities of operating your account from abroad? Which will be the session for Friday. You can go to woodburnglobal.com/events to do the registration. All the webinars are listed there. So who am I? I'm the only one speaking this week on all 5 days. My name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. I'm a leading expert on inbound investment into China. This just means that 100% of my clients are foreign investors establishing subsidiaries in China, or entrepreneurs establishing their first entities in the Chinese market. And I've got 17 years of on-the-ground experience based out of Shanghai, although currently due to COVID, I am in Europe for family and personal reasons. I've helped over 500 international companies with all stages of their development in China, whether that is market entry, whether that is implementation, whether that is scaling up and growing in the market. The focus for me is trying to help these foreign investors avoid the most common obstacles and roadblocks that pop up along the China journey. One of them being how to get your money out of China in a smart, efficient, and tax optimized way. The beauty of China now, 17 years after I've arrived, which was in 2003, is that a lot of things can be systematically set up. Processes can be implemented. Now, I know that administration is probably for most people not their strong suit, and something that they generally put at the bottom of their lists to do. But if you can create these system processes from day one of your China journey, it is going to make your life a lot easier, because along the way, things are set up and transactions can occur at that moment in time versus waiting around to do applications or to go through transactional procedures, which I'll explain in today just around the topic of profit repatriation, or simply just getting your money out of China, okay? So we can create these system processes from day one to make everything efficient, because in the end of the day, one of the biggest mistakes that I made arriving in 2003 was not implementing these types of system processes, trying to scale up and grow in China, but always hitting roadblocks that made me take 5 steps backwards to fix things, amend things, implement things, versus taking 5 steps forwards to scale and grow. And I want to educate you all on how to do that within your China businesses. So part 1 of this webinar series is looking at how can I get my profit out of China, and more importantly, can I get it out, right? That's one of the biggest concerns is, can the government prevent me from taking my money out of China? So what are we covering today? We're covering everything from the most common concerns that companies have, why it's important developing strategies. Are the tax authorities familiar with tax optimized structures? And how do you create systems where they get least suspicious? What are the basic requirements and procedures in China in terms of getting the money out through the normal route of dividends? And what methods of repatriation exist? Then we're going to finish off just on what are suspicious signs for the tax authorities and how to get your strategies up and implemented. All right. So it's a lot of content today. And again, take pen and paper if you wish to take any form of notes. So what are the common concerns from companies? Well, the first one is foreign exchange risk, which is everybody's concern. The next one is a political risk. Will the government allow me to take my money out? There's capital market concerns. And then there's the whole procedural complexity surrounding the process of getting money out, whether that's through profit repatriation strategies, whether that's through dividend transactions, or even just simply paying a supplier overseas. It all requires the same procedural process of getting your money out, okay? And there's a tax component there, and there's a bank component, not to mention the full document list that needs to be created. So these are the concerns that exist. Probably for me, the one that I see most, especially for newbies going into China, is the political side. You know, can the government ever stop me from taking my money out? And the answer very simply is no, they can't. You are running a business in China. Okay. Are they going to make it easy? No. But can you? Yes. As long as you've got all the documentation in place and you follow the procedural guideline to take your money out. Why is it important to develop profit repatriation strategies for your China business? Well, first of all, when we look at the time of 2008, 2009, during the financial crisis, a lot of companies, Chinese businesses, were growing and scaling up, and they had funds on the ground that could be used to help the other companies survive. So one thing that we saw amongst the tax bureau stats was the amount of contracts, overseas contracts, that were being submitted for approval to actually take money out of China during that period. Now, we want to continuously be able to have the opportunity to take money out if we want to. So developing these profit repatriation strategies gives you a mindset where you know from day one that these contracts are registered and you have the ability to take money out if and when you would like to, okay? The second is that it aids in creating a systemized process with true and authentic agreements. We're not creating anything that is fake, which did happen in the past, to allow your company to have access to capital if needed, whether that's your headquarter, whether that's another subsidiary in another jurisdiction, wherever it might be, okay? But it creates a system process that is set in stone, contracts submitted, that are true and authentic agreements. And most importantly, it gives you choice. All right. I was talking earlier regarding point one about mindset. We can create these agreements to help your mindset, knowing you can take money out, but you don't have to. Nobody's forcing you to take your money out of China. It's up to you whether from a strategic standpoint, you have to take it out, or whether you want to keep it in China for further investment, further growth, and to aid you in scaling up. Okay. So once you are thinking about, I want to take my money out frequently enough, because I don't want to leave a large pool of capital sitting in China, that's fine. That helps. If that helps your mindset in terms of investing into China, by all means do that. But nobody is forcing you to take your money out. And if you have a long-term vision of China, you might not want to take your money out. You might want to keep some of that profit for further investment to scale up, to grow in the Chinese market. Okay, we don't want to send money back and forth, back and forth. The bureaucratic procedures around this are complex. So we've got to be strategic. Why are we sending money out? For what reasons? Does it make sense in the long term of the company? Okay. So one aspect is mindset, because I know that affects a lot of people in terms of what they're doing in China. But the other is we have to think strategically whether it makes sense as well for the business. Why is it important to understand how to repatriate funds overseas? Well, first of all, it helps in understanding the China processes. Okay, you cannot change the bureaucratic procedures in China. You have to adapt yourself to the bureaucratic procedures in China. Okay, everything is possible, but it's not going to be easy. Because what is the ultimate goal of the Chinese government? It's that they want you to keep your profit sitting in China for further investment. They want your companies to grow in China and to scale up. All right. It helps them. It aids their own economy. Okay. The other aspect why I want to educate you on this is to help you with your communication with your China offices. Don't blame them for the bureaucratic procedures that they have to go through on the ground to get your money out. Okay. You have to be patient. You have to submit the right documentation, and you have to be patient for the approval process, not to mention then what the bank needs as well, okay? So I want you to be aware of this. Once you've learned what you've learned today, be kind to your Chinese counterparts in terms of what they have to physically go through to get the money out. The other aspect is, I don't want anybody to be cheated. And so I want people to be aware of the tax components when repatriating funds abroad. And obviously, I don't want you to be cheated by Chinese counterparts, whether that would be customers in China, where they are paying you and they're telling you all different types of different tax rates that would be applicable and that you are liable for. So I want that to be clarified today as well. And finally, it just helps you to get organized with the necessary documentation, okay? And again, to create a system process that can be copied and pasted into all different types of profit repatriation strategies. So I would normally do a poll, but I can't really, I'm not clear on how to do that with Zoom meetings. It's still something I'm learning about. But a question I want to raise is, do you believe that the Chinese authorities, tax authorities, are familiar with tax optimized structures? What is your perception of that? Do you think that they've got no clue? Do you think that they have a clue, but they're not really checking? Do you think that they are checking? What is your opinion on this? I'd love to know. If you want to type it in the chat box, please do. You can say, yes, they are familiar. No, they're not. Or yes, but they're not checking. It'd be great if you could interact. Let's see what's popped in. Chris says it depends. Elena says yes. Ultimately, to simplify the slideshow, Chris, I've said yes, but you're right, it does depend. And ultimately, it depends on the size of your business. If you are a small organization in China with little revenue, profitable, but I mean, the amounts are really, let's not, Chinese, let's put it another way, the Chinese authorities will have bigger fish to fry. You can get away with quite a lot. For the bigger fish, it's going to be more and more difficult. When you are a small fish, you should still be implementing these system processes so that as you scale up and as you grow, you don't have to spend time on administrative measures at that point. As you're scaling up, that's the last thing you should be thinking about is admin. So even though you're a small fish and this is not critical right now, you should still be thinking about all of these aspects I'm going to be going through today in order to make sure that from day one of your operation, you have things implemented. All right. So what I want people to get away with today is the following. We've got to create true and authentic agreements and contracts. I've used the UK as an example for today because the majority of registrants were from the UK. But we can use UK, Germany. I mean, you can relate this to wherever jurisdiction is your head office, okay? You want to create true, authentic agreements and contracts that are valid in China as well as in the UK or your home jurisdiction. You want to be smart about these agreements and contracts. You cannot fool the tax authorities in China. Fool them once, you can get it away. Fool them twice, that's on you. Okay? For me, there are two bureaus I will not mess with in China. One is the Tax Bureau and one is the Labor Bureau. Because again, I don't want to have to spend time with these authorities. And if they do investigate you, you'll be spending a lot of time, months, on having to deal with their questions, their investigations, their audits, etc. So the two that I don't want to deal with are tax and labor. You want to make sure that your overseas company has economic and commercial substance, i.e. that is not a pure holding company that has zero operations running through it. Because for the bigger fish, that's where dilemmas rise in and you can't benefit from the double taxation agreements. Fourth, you've got to understand that there are Forex issues in China. So depending on the value of the overseas payments that you are making, whether it's in renminbi, whether it's in USD, pound sterling, euro, whatever it might be in, understand that there are Forex issues. So if there is money that needs to be converted from renminbi into any foreign currency, it's going to take time, especially if the value is high compared to low. Okay, so you've got to plan that in the timing of doing any forms of repatriation. Okay, as I mentioned in the past, you could, when I arrived in China in 2003, 2004, you could easily create fake contracts and agreements to get money out of China. And the tax authorities were not educated, or the tax officers were not educated on what to ask for in terms of evidentiary proof on those agreements and contracts. Times have changed. You submit a contract, they will read through that contract and ask for additional information or documents to prove that the content is valid and true. Okay, and I'll go into details on questions they will ask or documents that you may have to provide. So I want to explain the most transparent route to get money out. If you've got an entity in China, what is the procedure to get it out clean and transparently if you follow the step-by-step procedures, okay? Obviously, if you follow this route, you're going to be paying more taxes, okay, in terms of profits tax and dividend withholding tax, etc. Okay, which is why we want to develop profit repatriation strategies to optimize everything. So the basic procedural steps for profit repatriation in terms of dividend repatriation. So in China, you've got to pay profits tax, okay? In general, profits tax is set at a rate of 25% throughout China. However, there are exceptions, which I want people to be aware of. If you are a small, medium-sized company, up until December 31st, 2022, if you've got 1 million RMB in taxable income, you're going to pay 3% profits tax. If it's between 1 and 3 million, you're going to pay 10% profits tax. And then anything above 3 million is at 25%. Or if you're a high-tech enterprise and you have the ability to fulfill all the necessary criteria on that, and you do an application, you can get a 15% profits tax rate. And if you register your companies in specific locations, like for example, the Qianhai Economic Zone in Shenzhen, you can also get a special rate of 15%, okay? So we're gonna go through this in more detail on Wednesday's session, if you're interested in that, where we look at the different tax implications around companies and also tax planning in relation to enterprise income tax, profits tax, etc. All right. Now in China, before distributing after-tax profits, foreign investors are required to make up any losses that have been carried forward from the previous years. And you can carry forward a loss for 5 years. Okay, so that needs to be settled. Additionally, foreign invested companies are required to allocate a certain rate of the after-tax profits to reserve funds, enterprise development funds, staff incentive, and welfare funds. Okay, all of this has to happen before you even think about dividend repatriation. All right. So what are reserve funds, enterprise development funds, staff incentive, and welfare funds? Okay, well, these are funds where ultimately you need to allocate 10% of your after-tax profit to these funds. And the cap on this fund is equivalent to 50% of your registered capital, which I'll be talking about in tomorrow's session. So if you designate your registered capital as $1 million US, you need to input 500,000 US dollars into the reserve fund. And if you want to have the additional funds of development, staff incentive, you can also allocate in there. But the reserve fund has to have a minimum of, or the equivalent of 50% of the registered capital. Okay. Before you can even again think about dividend repatriation. For joint venture organizations, there's no minimal or maximum limit on the amount. This is decided upon by the board of directors to allocate this form of ratio on their own initiative, and it's usually highlighted in the articles of association as well as the joint venture contract on what that will be. Why are there these reserve funds? Ultimately, because the Chinese government does not want you to leave your entity in China and your employees if suddenly things don't work out for you. At least you will have this reserve fund available that will be used to pay out salaries and whatever other debt you might have in China. Okay. Then you've got to think about transfer pricing regulations. So when we are talking to clients about profit repatriation strategies, this all ties in actually to tax planning, okay? Which again, should be done from day one, should not be done 5 years into your operation, okay? We wanna know when you're gonna start making profit, how is that profit gonna be kept? Or are you gonna take a profit first principle and say, okay, whatever money I make, a certain percentage has to be transferred back to the UK, back to the home jurisdiction, back to the head office. If you start developing these profit repatriation strategies, you do have to think about transfer pricing regulations in China. And the only slide, I mean, we can do a presentation on transfer pricing, but I just want to highlight one slide that I think is key for everybody to have in their mindset about transfer pricing, okay? The local file for transfer pricing needs to be prepared if you incur one of these 4 items. I've highlighted the 4th item because that's usually the first item that is hit for small, medium-sized companies, which is that if you have any related party transactions that exceed 40 million RMB, then you have to start preparing your local files. I mean, you should start preparing it probably a little bit before you hit the 40 million. But you need to know that if there's any sister related party transactions exceeding 40 million RMB, I'm warning you, the tax authorities will start asking to see your transfer pricing documentation, and they will want to see the local file, which is the file that pertains to your Chinese business. All right. So you've got to think about creating a transfer pricing strategy in your profit repatriation strategy. Okay. Not that you make 10 and you repatriate 10. Something has got to be kept in China. Okay. So it's working out what that percentage is that needs to be kept there. Then you've got to look at the double taxation agreements between the UK and China. And again, I've used the UK as an example here because the majority of you that are on here are from the UK. But of course, it could be the double taxation agreement between Germany and China, between the US and China, between France and China, wherever, okay? It could also be between Hong Kong and China, wherever your head office is, or wherever the shareholding entity of your China subsidiary is, okay? So we got to look at this table. Ultimately, I've given you history on this table, but what I want you to look at is the last column on the right-hand side as you look at the screen, which is, I call them the new DTA rates. They are the latest DTA rates, okay, associated with the double taxation agreement between the UK and China. So if you're repatriating dividends, there's a 5% withholding tax after all the profits tax that you've declared, as well as the reserve funds. If you create profit repatriation strategies, then interest and royalties, you're looking at 10% for interest, 6% for royalties. And if you decide to sell your business, you're looking at a capital gains tax of 10%. Okay. So you are looking at these rates, which obviously are enticing, particularly if you've got a taxable income of above 3 million RMB. Because as I mentioned, for SMEs, with taxable income of under 3 million, you're going to get special rates of 3%, 10%. If you go over 3 million, it starts getting interesting to develop profit repatriation strategies and to create a tax optimized structure for your China business. All right. So the question is, what is your China tax plan? When will you start making profit in China? Is it going to be from day one? Or will it take a certain number of years to get profitable? And if it does take a certain amount of years to get profitable, what are the tax rates at that point in time? This is also something that's very interesting and that I'm going to highlight in the session on Wednesday, is whatever you read in the news today about today's rates might not be applicable to you in 3 to 5 years' time when you start making profit. So be careful on how you budget your business, because nobody can guarantee China's rates. What the Qianhai Economic Zone has given as a 15% profits tax rate is for today. And you don't know what will be applicable later on in time. Okay? So I want people to be aware of this. During COVID, they've extended the SME benefits on taxable income by an additional year, and they even lowered the rate for 1 million and under from 5 to 3%. They did this out of the blue, right? There was no rumors going on. There was hope, but there were no rumors, and it happened suddenly. Great benefit to have, but how do you then plan for it? So tax planning is critical for your China business. You've got to understand when you're going to start making profit. Do you want to have a profits first principle where you take money out as soon as you start making it? Or are you going to have the principle of, we're going to leave money on the ground because we're going to scale up and we need that to expand? What is your strategy? And this is a numbers game. This is why the theme for this week is getting ahead of your China numbers, because it does require planning and understanding where we're going to take money out, when are we going to take money out, and then ultimately, how are we going to take that money out? Okay, so let's talk a little bit about the methods of repatriation from China. Okay, what options do you have to take money out? As I mentioned, the first one, the most transparent one, the one where you will get least questions asked as long as your structure is set up properly, is dividend repatriation. Okay, from a business strategy consideration, you have to have the after-tax profit can only be repatriated if the registered capital has all been injected. You've got the prior year's losses that have been made up, and you've got money sitting in the statutory reserve fund, which is at a cap of 50% of your registered capital amount. Only at that point that you can think about dividend repatriation. Okay, so again, my question to you is, when is that going to happen? If you develop strategic profit repatriation strategies, when will you be doing that? Have you done your tax planning around this? All right. When most people enter the Chinese market, they always do a 1-year projection. You should really be thinking about a 5 to 10 year projection with estimated figures. Okay. Might happen quicker, might happen slower, depends. In terms of the tax considerations for dividend repatriation, again, I'm using the UK as the example here because we've had the table on the previous slide. There is a 5% withholding tax that's imposed on the dividends distributed to the UK investors, as long as the UK company shows economic and commercial substance. If the value of this dividend repatriation is small, a couple $100,000, they probably won't spend the time to ask to prove the UK, whether the UK company shows the substance. If you're a big fish and the dividend repatriation is in the millions, they will ask for this. And you have to prove that that UK company is showing signs of operation, and that it's not just a pure holding company. Historically, people were establishing Hong Kong holding companies as the intermediary entity between their home jurisdiction entities and China as a protective measure. But back in those days, the Chinese government wasn't asking any questions when you repatriated. And today they are. And we are seeing a trend where for any companies that have this Hong Kong intermediary company, if it has been purely holding, they have not been able to benefit from the 5% withholding tax rate because they cannot prove economic and commercial substance, which means the rate goes up to 10%. Again, we're not being strategic if that is happening. So you've got to show that the company is showing transactions, that it's operational, it's running something somehow, and you can show proof of that. In terms of the outbound payment process outbound payment process for dividends, there's an approval from the tax bureau that has to happen. So what does this mean? When you look at your fiscal year, which is January to December in China, it's fixed January to December. The following year, so let's use 2021 as the fiscal year. In 2022, you're going to do your annual audit and your annual tax compliance procedures latest by May 31st, right? Might even be sooner than that, might be April 30th. You need to have those documents available, the annual audit and tax compliance documents available before you can start doing anything. You need to have a resolution, board resolution, executive director resolution signed that you are going to be distributing profits as dividends. Okay. Then you need to go through the procedure with the tax bureau to apply for the Dta benefits. And this is where they are going to check that the shareholder is not a pure holding company. Okay. Then you've got to file the profits tax, the annual profits tax return. And if the amount for the dividends is over $50,000 US, then you have to do a record filing with the tax bureau as well, which just is an additional application procedure. Okay. And then you go to the bank. Now, what I've listed here as those 5 key components to the approval from the tax bureau, there may be additional documents required. There may be additional procedures required. It depends on how big of a fish you are and what's the value that you want to repatriate. So I'm going to repeat this many times in this presentation. Communication with your tax officer is vital. If you don't have an open communication channel with them and you don't ask them ahead of time what is required, you are going to be spending weeks on getting all of the documentation together. So if, again, it comes down to your tax planning. If you have the idea today that you're going to be repatriating dividends in 2022, start that communication today with your tax bureau and ask, what are the documents required to repatriate dividends out? All right, start that today because we're already almost in October, so that everything is prepared ahead of time. What we don't want is that we rush, we get documents wrong, and it takes even longer to repatriate. Let's be proactive, have open communication, and discuss with our tax officer what we're planning on doing ahead of time so we can create systemized processes. Okay, this is just tax bureau, then goes to the bank. That's a whole nother series of documentation that has to be prepared. There are the application forms, Again, you have the signed board resolutions, executive director resolutions. You've got the audit reports, tax compliance reports. You've got the tax record filing form that will be stamped from the tax bureau. And you have to show proof that the registered capital has been paid and the reserve fund has been capped. This is just the documents from the bank. And again, they go through their KYC process, their know your client process, their compliance, internal compliance procedures to make sure that you've paid your taxes, but that you're also not repatriating black money. Okay? So it is critical that you know the procedures. So again, open dialogue. Go to your relationship manager or go to the bank teller at the bank that you're collaborating with, working with, and ask them today, what is the document list that needs to be provided? And then go through that document list with them. Now, that's dividend repatriation, okay? Which again, is the most transparent. And besides the economic and commercial substance component related to the holding company, it's the easiest form of profit repatriation where you're literally making profit, you've paid your taxes. What's the government going to say? You can't repatriate dividends back to the shareholder? Of course you can. Okay? They just want to make sure, and even if you don't fulfill the economic and commercial substance, it just means you pay a higher tax rate to get the money out. Okay? But what we want to do is be strategic. How are we going to get money out of China that is tax optimized and is strategic? Okay, so the first is service fees. Okay, so from a legal and business strategy consideration, you need to have a valid and true business reason for implementing the service fee. What is that economic substance? Is it a marketing service agreement, which basically means that the head office is paying for all marketing fees associated with a China subsidiary, and China needs to pay that back? Well, if that is truly the case, then the headquarters will have invoices, they will have contracts with media agencies, and they can show that as proof that China has to pay back these amounts. All right. If the UK has paid for the development of the Chinese website, well, there's proof of payment to a web developer for this Chinese site. Okay, and this is all under a marketing service agreement, but again, it has to be true. Or you've got management service agreements, which nowadays are a little bit tricky to prove. Because in the past, the management service agreements would come into play when managers from the UK would travel to China for a certain period of time, and all of their expenses and time commitment that were being placed on the China business would be paid back to the UK from the Chinese subsidiary. And what the tax bureaus would want to see was the entry and exit stamps from these managers that were traveling to China. Well, we are living in COVID times. So how do we prove that? Right? Nobody's traveling. So now it comes in down to the simplest form that we found is timesheets, which is not efficient or effective or anything like that. But it's basically saying, let's say there's a manager sitting in the UK and his title is Chinese export manager, Chinese sales manager, whatever it might be. And for his time spent on the China business, he needs to be paid back to the UK. There are a lot of foreigners that have been repatriated out of China and are currently fulfilling their jobs for the Chinese business abroad, right? And you just have to show proof that they were in China, had visas for China under COVID times, they're sitting abroad, and they need to get paid back their salaries or whatever else it might be. But again, whenever you're developing an agreement, think about how you can substantiate it with additional documentation. Okay. Technical service agreement. Well, we all know that if you are selling a piece of equipment in China, there's going to be a technical component to it. You might not have people on the ground that can fulfill that. So you need to send technicians, engineers, whatever it might be, over to China to do the installations or after sale service or repair service or whatever it might be. Again, in the past, you'd have people flying over, you'd have the entry and exit stamps. The question today is, how can you prove that you're doing technical service abroad for your China business, and hence money has to flow out to cover those costs? Okay, always thinking, how can you substantiate that? Is it through emails? Is it through an internal, even if there is an internal service agreement, what other documentation can you show proof of for the time spent or for the specific clients that you've acquired, etc. And when you're developing these service agreements and you're analyzing the service fees, you need to think about your transfer pricing model. Okay, because again, I'm going to reiterate that red sentence that I highlighted under the transfer pricing slide, which was, if you've got sister related transactions up to 40 million RMB, you'll have to start submitting the local file for transfer pricing to the Chinese tax authorities. Get that set up now. All right. Contracts should be in place with all these agreements. It should be in the Chinese language, but obviously what we want to do is create agreements that are valid both for the Chinese government as well as for the UK government, because these are cross-border agreements that have to be fulfilled in 2 jurisdictions, right? So we want to make sure that they're in Chinese because it's going to be submitted to the tax authorities, but you also want them to be in English or in German or whatever other language that might be required for the audit that's taking place in your home jurisdiction. All right. And you want to make sure that the contract clauses and terms are valid for both jurisdictions. Remember, these are internal agreements, so you can be flexible with them, but they still need to be good enough for proof for the tax authorities in both jurisdictions or for the audits that they may go through in both jurisdictions. And then ultimately be aware of permanent establishment guidelines, right? So if you are sending out technicians or managers out, understand what those permanent establishment guidelines are between the UK and China. Usually the rule is 180 days. All right. So that's the legal business strategy around that. Then you got to think about the tax considerations. Okay. Depending on the type of agreement or service that you have implemented, VAT may be applicable or may not. Okay. VAT could be refunded depending on the service, or it could be actually exempt depending on the service that you have chosen. So as a UK company, I do not see why you should be liable for that, being that you cannot physically go and pay those amounts. It's going to be the Chinese company that does it, okay? Because they are the entity registered in China that is then registered with the tax bureau to settle the VAT liabilities that exist, okay? So when you're doing your agreements, think about the cost calculations in terms of service fee amounts and VAT applicable on those service amounts. Will also depend on the tax status of your Chinese entity, whether it's a general VAT taxpayer or whether it's a small scale taxpayer. All right. And again, think about the licensing fee, the licensing rates and royalty rates within the double taxation agreement. Okay. Which will vary depending on the jurisdiction you're sending it out to, and where the shareholder is based. Now, in order to do the outbound payment process, you first have to do an approval at the tax bureau, where the contract needs to be registered with the tax bureau. Do not underestimate the time requirement to get a contract registered. Can take anywhere from 4 to 12 to 16 weeks, depending on the priorities of your tax officer and how quickly he can go through that approval. And then do not underestimate, as he's approving that contract, what additional documentation you need to provide to prove the service. Okay. Applying for the DTA benefits, make sure that the shareholding company is not a pure holding company. Otherwise, you won't benefit from the DTA rates. So again, in that aspect, the government might ask for additional proof of who the shareholder is and what types of operation are existing within it. You will have to do a filing of the profits tax associated with those, with the contracts, or you have to show proof of profits tax filing in the past. Depending on the invoice values, you might have to show a record filing done with the tax bureau. Okay, and then you do the bank payment. Now, for items 3 and 4, this will happen at the point that the transaction is actually occurring. Our recommendation is to get points 1 and 2 done way before you even start transacting. Because like I said, contract registration and applying for the DTA benefits can be anything from 4 to 16 weeks to get approved, right? Time consuming. But you know this now, so let's be proactive. Let's get this done ahead of time. And then at the point of transaction, you show the filing of the profits tax, you do the record filing with the tax bureau, and then things get systemized. Even if you've got suppliers that you want to pay from your Chinese entity, this is the same process that has to happen, guys. Then you go to the bank payment. And at the bank payment, you have to submit the service contract that's already been approved by the tax bureau. You have to show the invoice or the payment notice. And you will have to show any other document that may be required to show proof of the authenticity and true value of the transaction. Because again, the bank does not want to take the risk of sending out any black money. So they will want to see proof. And again, it depends on how big that value is that's being repatriated, how big of a fish you are, as to how lengthy that documentation list might be from the bank. So again, get prepared ahead of time. If you're planning on setting up a repatriation strategy today, you don't expect the transactions to be fulfilled until another 6 months, 1 year. Well, ask for the document list now so you can get prepared. Being prepared saves you a lot of time in China. Then you've got royalty fees, where it's exactly the same concept as the service fees. Okay. It is about implementing valid and true business reasons for the services that you're invoicing for. Whether it's a technology transfer agreement, whether it's a trademark licensing agreement, okay? Which is trademark licensing is probably the easiest way of getting money out, mind you. Because if you've done your trademark registration in China, you've got the certificate of registration, by all means, you can set up a trademark licensing agreement. All right. For those of you who aren't aware of what that means, it just means that the UK is licensing out its brand assets to the Chinese company, and the Chinese company is paying the UK for those brand assets, for the use of those brand assets. Again, when you're doing these types of agreements, you've got to think about transfer pricing model, get that straight from the beginning. From a Chinese perspective, contracts should be in Chinese language, but again, we always recommend it to be at least bilingual Chinese English. It should be valid in the 2 jurisdictions. Okay. Tax considerations. All right. In practice, you're going to often see that the withholding tax rate is around 6%, stipulated by the double taxation agreement. Okay. Then you got to think about VAT, and also understand if for that service, the VAT can be refunded or exempted in China. Then all of these are just having an open dialogue communication to understand the expectation from your tax officer and what documents have to be submitted, but doing all of this ahead of time. Not doing it in the moment where you're stressed, you're under pressure, and the head office is saying, we want our money today. Won't happen, simply won't happen. And there are no miracles out there to get that to happen. All right, so it's about being proactive and getting things done ahead of time. And again, the outbound payment process, this list is identical to the service fees one. So again, for points 1 and 2, get the contract registration and apply for the DTA benefits ahead of time, months ahead of time. And then at the point of the invoice, do the profits tax filing, record filing, done. Okay. And then you go to the bank. And for royalty fees, they will do the application form, contract has to be registered because this will be potentially something that's also recurring. You'll have to show your business license. They may ask to see the business license of the shareholding company or sister company. If the fee is paid as a commission, they may want to see how you've made up that formula or calculation. They might want to see a special audit or financial statement. They may want to see the latest audit report of the Chinese company. And then obviously if it's trademark or patent license related, they will want to see the certificate of registration in China for that and who actually owns it. So in the past, again, when I first started out in China, there would be, let's say, I'm going to make it up now, a scenario, there would be UK companies that registered trademarks in China, but then did the invoicing out of Hong Kong to keep money in Hong Kong. That won't work today. If it does not match the invoice together with the certificate of registration and who the owner is, you won't be able to repatriate. Everything has to match. All right. Now, those are the most common forms of profit repatriation. And of course, you can be more creative based on true and valid situations that may arise. Okay. As you will see, I've not included anything here that is trade related because trade transactions are a different format. You're selling goods, the goods have to have arrived in China, or you've exported from China, and you're selling the goods to your subsidiary. So trade is a different ball game compared to other things, right? But of course, you know, if you're following transfer pricing principles, it depends on how you do your pricing when you're selling the goods, buying the goods, etc. Okay. But I do want to highlight here other methods for repatriation. Capital reduction. This is not actually a form of repatriating funds, but it is a form of lowering your financing capabilities in China because you don't need it. You don't need those funds anymore. And so you go through an application to reduce your registered capital. Very difficult procedure to go through, almost impossible to get approvals. I leave it out as an option. Okay, it is a possibility. You could also have your Chinese company acquire overseas assets, meaning it's paying for things and the money is flowing out. Then it's acquiring assets overseas. You can have your Chinese company offer an offshore loan to the overseas shareholder. You can adjust your transfer pricing models so that more capital is repatriated out for certain transactions. And then obviously there are all types of offshore investments. And there are Chinese companies out there now, not owned by Chinese, but foreign invested companies in China now that are investing in acquiring companies in Southeast Asia or other types of jurisdictions. With any of these 5 items, don't make a decision just by yourself. Speak to experts, whether it's lawyers, whether it's tax advisors in the various jurisdictions to make sure that these transactions might be beneficial to you or not. Okay, you've got to make that evaluation. I've listed them here so that you've got a complete overview. But again, these are not common transactions that happen on a day-to-day basis. The ones previously that I highlighted are the most common ones. So we're going to finish off by looking at what the tax authorities find suspicious. And we're going to look at a strategy that you can implement, okay? Whether you're an experienced China hand, a newbie, or a startup in China, basically. So what the tax authorities find suspicious is the following. If there are a significant amount of related party transactions, by significant, I mean also that you are doing this often, okay? Not just one transaction every 6 months, but you're doing a transaction every month. You might be doing 2 transactions every month to sister related companies, okay? That will be suspicious, all right? If you also don't have stability within your company, meaning that you've got a roller coaster design of low profitability, high profitability, low profitability, high profitability, that will raise suspicions as well. And don't forget that profits tax is declared on a quarterly basis. So the authorities will be looking at that on a quarterly basis. Okay. The tax authorities have now industry standards available to them at their fingertips, which is basically historical trends of your industry sector through time. And if you've got lower than average profitability for your industry or your sector, questions will be raised as to why. And then they may look at other transactions that are occurring and why that is happening. Okay. If you've got business dealings with companies that are established in tax havens like Seychelles, Jersey, Guernsey, BVI, Mauritius, etc., be prepared for more questions to be raised. Places like Hong Kong and Singapore and Luxembourg are starting. They used to not be really tax havens. Now, again, if you're a big fish, questions will be raised. If the values of your business transactions are high, questions will be raised. So be aware of that. Make sure you know how to answer these questions. If you get asked by your tax officer to submit the local file for your transfer pricing and you don't, then again, suspicions will be raised. Okay, and if you haven't followed the arm's length principles of your transactions, again, suspicions will be raised. A lot of these things will happen in conjunction one with another. One thing I can just recommend is don't go through a tax audit. You don't want to go through a tax audit in China. Okay, it is a painful exercise. Okay, and sometimes tax audits can be compliments because the government thinks you're doing so well. Why are you doing so well? Or it can be tax audits where you're not profitable, you haven't been profitable for a number of sequential years. And the question is, why are you still in China? If that's the case. So, we want to avoid the tax audit. We want to avoid questions from the tax bureau because, again, this is not where you should be spending your time. Your time should be spent on scaling up the business. So we want to create a sound foundation for your company from day one in order to make sure all of these systems and processes are set up, that you don't just throw in a service agreement, a trademark licensing agreement without thinking about transfer pricing, without thinking about the double taxation agreements. The strategy has to be behind all of these agreements. And hopefully you get the advice around these as well so that you don't hit any tax audits. Right? Now, a question you might have, I haven't looked at the Q&A, might be, well, if I set up an agreement today and I fix certain percentages that will reflect our business today, what happens if in 1 or 2 years' time I've got to change those percentages to reflect the business? Of course you can. You can change the content in your agreements, but just remember that the updates, the amendments, have to then be approved by the tax authorities, and that takes time. Okay, so just be proactive that if you make those changes, you do that ahead of time and you do those registrations ahead of time. It's about being proactive and doing your planning. Right. And then to finish off today, we're going to look at tips to get your strategy set up on time. Okay, so the first is, again, planning. It's all about planning. What are the most simplest forms of agreements we can set up that are true and valid, like the trademark licensing agreement, like management agreements, because you will have people in your head office contributing to the growth of your China business organization, and they probably should get paid for that time spent, or the company should get reimbursed for that time spent that's being allocated to China. Okay, so let's think about your business, what transactions flow through it, how you operate, to then think about what type of agreements and contracts should be established. Okay, we want to create true and authentic agreements, so the agreements should be drafted based on reality in Chinese. I always say English should be added in there because bilingual is at a minimum. We need to look at tax components. We have to look at double taxation agreements. We have to look at transfer pricing principles. That's your homework, basically. if you want to create these types of agreements. Be smart and choose your battles, whether it's with the tax bureau, bank, or any other government bureau, okay? So when I say be smart and choose your battles, don't fight every little thing that the tax officer is going to say when he comes back to you about the negotiation with your agreements and contracts. Sometimes you just have to abide by what they say. Choose your battles wisely. Do not fight everything. Otherwise, you become that pain in the butt client for the tax officer who just will not support your business. And that's what you also don't want. You also don't want to be the pain in the butt client with the bank who then says, actually, you know what? I'd rather lose you as a client than gain you as a client because I'm not anyway earning enough fees from you. That does happen. Tune in for Friday's session. All right. So be smart, choose your battles, and know how you're going to negotiate with your tax officer, with your bank, with any other government bureau, whether it's the State Administration of Foreign Exchange as well. You want to conduct the contract registration as soon as possible with the competent authorities before the first remittance even occurs. Like I said, that process can take anywhere between 4 and 16 weeks. I did one of those this year in January. I could not do the first transaction until end of March. It took 3 months to get the, sorry, I started in December. I started in December 2020. First transaction happened end of March. It did take 12 weeks for me to get that contract approved. Okay, so be aware of that. Now, I also want to relate this to just simple business transactions. If you are a UK company that is transacting with a Chinese company that you're no relationship, they are a client or whatever that relationship might be with them, right? And you've got a contract. Your Chinese counterpart has to register that business contract. And that again can take up to 12 weeks, which is why if you issue that invoice straight away, it's not going to be paid until that contract is registered. Okay, again, it's just having understanding of how things work in China. You want to apply, oh, and just as a tip in terms of the contract registrations, my recommendation would be to have open-ended contracts in place. Don't have specific time frames, although sometimes you might have to have specific time frames depending on what you're selling and if it's project related, but try to have them as open-ended as possible, because every time there's a new contract, you have to go through the registration process, even though the content is identical. So understand the timing of those contracts. I have a supplier in the UK, and unfortunately our contracts are on a yearly basis because of the projects they perform for me, and hence I have to start in December with the new contract registration. I might even have to start doing that a bit earlier. So it's again just a tip for you in terms of how you word your contracts. Apply to the tax authority for the tax assessment during the contract registration. Tax assessment does not refer to the DTA. That's the next point. What I mean by tax assessment is what VAT are you paying? What's the VAT rate? Is it based on small scale, general VAT? What is it? Are there any other taxes that have to be paid based on the content of that agreement besides VAT? So make sure you get that tax assessment done as the contract is being registered. The next point is also look at the treaty benefits and get that approved at the point of the contract registration as well. And then once you have your contract registered, ask the bank and ask the tax bureau for the document list that is required every time you want to do a repatriation. And also I want you to be aware that the document list that you get today might not be the same document list as you get on the day that the transaction has to occur, but at least you are prepared with the majority of the documents being the same. Okay, so that if there's any differences, 1 or 2 differences of documents, you can get those prepared at the point. You don't have to prepare the full list. But open dialogue is key. Ask the bank and the tax bureau for what that is. So that's the end of today's presentation. Just to finish off, I did promise that I was going to talk about how individuals can get money out of China. So if you are a foreigner and you are a resident in China, you can get your salary out of China, okay? The key is making sure that you have paid your income tax in China and you've got your income tax filings. You also have your employment contract and you show those two documents to your bank and you can then repatriate the funds. Once you show your income tax and that tax has been paid on the income you've already received from your company, there is actually no threshold with the 50,000 US dollar. So I'm not sure if you were aware of that, but there isn't, because you've paid your taxes, you can repatriate. And it's just, again, a matter of talking to your bank, submitting those documents, and then being able to do that remittance abroad. I hope that's helped. And then, you know, I have a lot of friends that are wealth managers in Shanghai. And even if you don't want to do that formal TT transfer from your bank in China to your bank abroad, you can also get certain, you know, Union Pay debit cards and things like that that you can use abroad in any case. So be aware of that as well. Depends on which banks that you're collaborating with. So I'd love to know what your takeaways for today were. Please do let me know. Just briefly, how you can work with me. We do all of these types of things, from budget creation and validation to tax advisory, tax planning, thinking about ERP systems, doing full or partial outsourcing of your accounts, taxes, and payrolls in China, creating operational guidelines and system processes, doing health checks, doing internal accounting and tax compliance reviews, and designing profit repatriation strategies as well. In terms of designing the profit repatriation strategies, we're not lawyers. We don't draft the contracts. That should be done by lawyers. But what we do is we review those with the lawyers to look at the tax components. And if you are a good client, we would also then communicate with your UK tax advisor, for example, to make sure that everything is in alignment, which is what the goal should be. So if you're interested in those services, you can book a strategy session with me. The link to my diary is here. I am just going to pop all of that in 1 second to the chat so everybody has it. Let me send that so you've all got it now. And you can easily reach out to me. Oops. And I didn't put a Q&A slide. I really apologize, but we can start the Q&A now. I'm going to go through all of the questions that have popped in. So Elena, your first question prior to the presentation even starting was, if we were to use management charges, how should these be worded to make sure no withholding tax is charged? I don't know what you mean by withholding tax. Are you referring to the DTA rates, the interest rates, or the royalty fee rates? What are you referring to in terms of withholding tax? There will be withholding tax no matter what that needs to be paid. You can't avoid them. That's impossible to avoid them. So there's no wording where you can say, I'm not going to pay taxes in China in terms of what needs to be repatriated out. I'm not sure if I answered your question. I'm just reading it based on what you've written there. I'm just going through all the questions. So from Timur, is it after all really only a question of proper documentation to transfer renminbi payments abroad? Have clients who can and those who can't. It is a matter of proper documentation. And like I said, there has to be validity and truth behind them. If there isn't, and you cannot show documentation to your tax officer who requests it, well, then you're not going to get the approval to remit. So you need to make sure that you have the proper documentation, that you can answer all of the questions from your tax officer if they come. If he asks for more, that you again can submit documents or answer those questions to be able to get those payments out. but it's no longer the case of creating something that's fake. It's a matter of now creating something that is, again, real and valid. Elena, you're going back to that same question, I think. Can managers actually be based in the UK, for example, but spend part of their time managing the Chinese business? Yes. Well, that's the world we are living in right now, Elena. So actually, you have a lot of people like myself, where I've been repatriated. I left February 2020. So I have unfortunately lost my residence visa, my work permit, and I no longer give myself a salary from the China business. But I do ask China to pay a consulting fee to get paid. I'm in a different circumstance. This is my own business. In your situation, if you've got people in China that are managing the Chinese business, then yeah, because there's no entry exit visas, timesheets would actually be the easiest way to prove what they are doing. We've had some clients who've had to show email correspondences to show what they're doing. For example, if they are technical people and they're assigned to do a, I don't know, Zoom video call to install something, which does happen nowadays, then the time spent on those Zoom calls will be charged back. And it's about showing the proof that those calls were scheduled and actually did occur. They're not going to ask for the video recordings of those calls, right? But they'll want the email correspondence associated with that, and who the client is that you were handling that for. But yes, timesheets would work. In terms of the next question, which is there an amount that will go through without any questions asked? There's no guarantee that no questions will be asked at any time, even if the amounts are small, peanuts, whatever. There is no guarantee that you won't get feedback from your tax officer. All I can say is this: if you've got a contract for a management contract in place and you've gotten that registered, then usually the majority of questions will come in the first transaction. So I'll give you the example of my situation. I have an overseas supplier. I registered the contract. There were questions during that registration. When I got that first invoice, they wanted proof to see what they had done for me. I showed it to them. But since then, every other invoice, which has been identical and the same amounts, I've never received further questions from. But you just never know if the tax officer is going to refresh his memory and ask again. But in theory, with the first contract registration and the first transaction that occurs, that's where it's heavy lifting and tedious. Thereafter, it really should be getting easier, unless you really have an idiot as a tax officer, quite frankly. Do the authorities ask about the basis of trademark licensing agreement and how this basis should be structured? There are several aspects to that question, actually. So when you say structured, you've got a trademark licensing agreement, which means the UK has registered its brand assets in China. It might be a variety of different logos. You've got a licensing agreement with your Chinese entity. The questions that will pop up is, how have you created the formula to base the service fee on? Is that formula logical? So I can give you an example. I had one client who actually created a licensing agreement, and they put the rate of 14% based on sales earned each month. And the tax officer just found that percentage extremely high, above industry standard. And they did not accept the rate. So you've got to make things logical. Remember, one of the aspects I said is look at your industry standards, right? They're going to look at that to see how you're formulating your transactions. That's what I would say about the trademark licensing agreement, is that they're going to ask for the certificate, and then they're going to say, okay, that service fee, how have you calculated that formula? What is it based on? Is it logical? And is it based on industry standards? Jamie, your question is, which of the seminars this week are best to learn more about trading out of the UK into Asia through a Chinese subsidiary manufacturing business? Is that if the China subsidiary is not yours, then no other sessions this week will be applicable to you. But we are doing a webinar series in October about procurement in China, and we're going to be talking a lot about physical trade transactions then. They're not set up yet, but just stay tuned for that. I'm going to set them up within this week. Hope that answers your question on that. A couple more questions. That's it. That's popped in. Oh, Timur, you mentioned Forex problems in the beginning. Do companies predominantly transfer back in pound sterling in your observations? So that's a really good question. If I were you, if I were a UK company today, I would set up a renminbi account in the UK. Why would I do that? I would do that because it means that your Chinese subsidiary or your Chinese business partners would only have to repatriate in renminbi. They wouldn't have to go through any Forex application procedures to get pound sterling or US dollar out. This also lowers the time to get the money out. What it means, though, is that you, as a UK company, have then a renminbi account in the UK, and then you control as well how you want to manage that renminbi in the account, and at what time do you want to do your conversions into other currencies. That's what I would recommend. If you don't want to set up a renminbi account in the UK, then the currency conversion depends on the business. So I also have UK clients who predominantly transact in US dollar, and so they'll repatriate US dollar back. That really depends on the business and in what currency they keep their funds in. And then, oh, Timur, you were saying that's what you do for your clients, but many times it seems to be more paperwork with the authorities. I don't know why that would be. I don't know. Again, it might just be because in the contract registration and the first invoice, there are more questions, but following from there, it should be actually a lot easier and quicker. So I'm not sure what additional paperwork the authorities would be asking for in terms of, I assume you mean the tax authorities and the bank. Again, the heavy lifting happens in the contract registration phase and the follow-up on the first invoice, right? Then after that, it's actually just consequential, right? Invoices that follow on. That's all that's popped in. I'm very happy to hear that you guys have found this session useful. That's the aim, to give transparency and clarity to everyone. Tomorrow, I'm going to be doing a webinar session, which is looking at the financial resources in China. I'm doing this with the CBBC. So it's actually using the CBBC platform, the China Britain Business Council platform. Again, the link is on our website. We're going to be looking at all the different forms of financing in your initial stages of setup, but also later on, if you're well established and you need additional financing, how would that work? Then on Wednesday, we're looking at preferential tax policies and how to do a tax planning simulation. Then on Thursday, VAT. What is VAT? What's the golden tax system? How does that all work? And how does it involve you in transactions? And then on the last session on Friday is basically, I'm getting a lot of people having difficulties with their bank accounts in China. And so, and obviously the issue is we can't travel there and we want to make sure we can operate our accounts from wherever we are. So I want to touch on how I am personally operating my account from abroad, but also just very simply what it means to operate an account from abroad. All right. If you're interested in these sessions, go to woodburnglobal.com, which I'll just type in right now. So you've got the link in the chat to register as well. Again, I hope this session's been really useful to you. If you've got any other questions, again, set up a one-to-one with me. Happy to discuss with you for 15 minutes, 30 minutes about what you might be needing. All right. Hopefully I will see you all again tomorrow or in the next few days. Have a great afternoon. Take care and goodbye.